Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for this segment, we have Josh Frank, co-founder and CEO of The Tie, an information services provider for digital assets. He's here to discuss institutional adoption of digital assets. Josh, it's great to meet with you. Welcome to Trade Talks.
Thanks for having me on.
You got it. And it's interesting, this rally is not retail driven. It seems to have taken more of an institutional focus than years past. What are you seeing in terms of the data?
Yeah, so I think there's a couple interesting proxies for retail and institutional interest. It's obviously a difficult question. I think some of the interesting proxies that we have is actually the number of active addresses on a blockchain like Ethereum. So we're seeing about 430-ish thousand active addresses on Ethereum over the last month versus, but for perspective, by the way, that's around the numbers that we were seeing in December of 2020. So we're looking at kind of, that last bull market when it started in December 2020 on the back of kind of that Bitcoin hedging narrative that we saw. Those are kind of comparable numbers versus we were seeing about 700,000 active addresses in May of 2021. So we're down about 50% from there. I think the other interesting retail proxy is Twitter activity. How many people are actually talking about these assets? And we're seeing about 80 or so thousand tweets a day on Bitcoin, which is slightly up from what we saw before, but significantly down from its all-time high. So also down about 50% from Bitcoin's all-time high. Which again was a similar time frame around last summer. So it's really clear that it's not retail driven. We haven't seen a big uptick on anything. I think another example of that is Coinbase in their quarterly report. Obviously, they haven't published Q1 yet, so we don't know what the data shows. But last quarter, they showed that 86% of their volume was institutional. That number was about 68% in the year prior if we looked at Q4 21 versus Q4 22. So it's very clear that kind of that volume is moving from retail to institutional. And one thing that we're seeing, which is interesting, is the CME has to report their commitment of traders. And we've seen, what we've been seeing is that asset managers are now actually 49% of open long interest on the CME, which is really interesting. So it's actually asset managers that in some way are actually moving into this market and driving the market. Whereas we're seeing hedge funds that are actually net short crypto at this point, at least on the CME, we're seeing asset managers go long. And that's a shift that's been happening over the last few weeks, the last few months. So it's clear that, I wouldn't describe it as the institutions are all here, right? There's a lot of barriers and I'm happy to talk about that, but this is certainly not being driven by retail market participants.
Right. And we're going to get to that in a moment. But when you think about crypto, is it in a bull market? What are some of those catalysts that it would take if not?
In order to get retail back in, is that kind of the
right? In order to get retail back in or get into like
to move the bull market? Yeah. So I think there's a few different things. I think regulatory clarity is obviously the biggest thing. Right now the SEC came out and said everything is a security, and then the CFTC the other day in their lawsuit against Binance said Bitcoin, ETH, and Litecoin aren't a security. So even within the U.S., there's different regulators are saying different things, right? So I think that's part of it. I think we've seen within Europe there's something called MiCA, which is crypto-related regulation, which is going to help, particularly around stable coins, but also kind of, there's a thought that in the long run, it's going to help with broader crypto regulation, which is going to enable adoption. But I think there are significant barriers to a bull market, right? And I think a lot of them are institutional in nature. I think the biggest one is reputational risk. If you look at what happened around the FTX collapse, a lot of the venture partners that actually invested in FTX at these large traditional asset managers or hedge funds or venture funds, they got fired. Right. And so there's now this concern that like, okay, if I'm going to be the person who puts my name on crypto, I might not have a job. Right. And so that's a really big barrier that we need to get over. Right. It can't be a reputational risk to get into crypto. And I think FTX scared a lot of people. And I think a lot of the other things that are happening have scared a lot of people. So, an example of that is I just heard from a top 20 hedge fund this morning that was trading proprietary capital. They were trading partners capital. And they decided to shut that down because of what happened with Binance, right? And they were originally like, let's start with partners capital and then let's move and trade, outside investor capital. And so I think, we require regulatory clarity. We probably need 6 months of something bad not happening because it's seemingly every day in crypto, there's something else, whether it turns out that SBF bribed regulators, CZ got sued by the CFTC, like this all this week, right? And so I think we need regulatory clarity. We need, reputational risk can't be a problem, right? And the market can't go down, and then we need better infrastructure, right? So better choices of venues that you can do business with. The lenders all blew up. there's very few OTC desks left. And now with Binance, with, the CFTC at their back, besides Coinbase, how many exchanges are there that you can kind of trust?
Right. And Josh, the first quarter in general was just, I mean, you could have packed a number of market events in a few years into the first quarter that we saw in 2023. So I want to talk about that, the broader macro environment. We know cost of capital is expensive. We know that people are dialing back their willingness to inject capital, particularly within the crypto space. How do you think the broader macro environment is going to impact this space? The same as what you would see in other public markets, or are there different nuances for the crypto space?
So I think there's some overlap and there's some nuance. So on the overlap side, a huge reason that the market really moved the way that it did was traditional venture capital coming into the space. And the space became extremely flush with venture capital, right? And that happened with FTX that raised billions of dollars and others, right? I don't think we're going to see the same inflow of cash from traditional venture investors into the space, right? And I think that's kind of across the board, right? Venture investors are dialing back because it's more difficult for them to raise money. Allocators aren't allocating, so investors aren't able to invest, right? And so I think that's part of it. I think from a macro perspective, Bitcoin is, there have been times where people have called it a risk-off asset, but certainly it's behaved as a risk-on asset in many cases. Maybe it's not behaving that way now, but I think there's some nuance there. One of the biggest nuances is actually the crypto venture space. So a lot of crypto venture investors have raised a tremendous amount of capital, right? They've raised $300 million funds, $400 million funds, $500 million funds to invest in crypto growth. Turns out there's not many great crypto growth companies yet. There's not very many companies that have long-term sustainable revenue. A lot of the revenue of crypto companies looks like the Coinbase trading volume. You can use that as a proxy, right? And so when the market goes up, the revenue goes up. When the market goes down, the revenue goes down. There's very few companies that actually have sustainable recurring revenue in this space. And so what does that mean? That means there's all these venture investors that are kind of, they're cash heavy and they don't really know what to do with it. And they're actually looking to Bitcoin and ETH and actually investing, the money that their LPs gave them in BTC and ETH. And that's unique, right? And I think that might be part of driving the market. And I think we also have a couple of crypto specific events that have an opportunity to impact the market. I think the biggest one is the Ripple case. So the Ripple SEC lawsuit. So if anybody's been following, Ripple is actually among assets above $1 billion in market cap, the best performing asset over the last 7 and 30 days. And it is the only large cryptocurrency that's outperformed Bitcoin over the last month. So this rally has really been a Bitcoin rally up to around $27,000 where we're sitting today, right? But XRP is also performing, and that's because there is a belief in the market. I mean, as soon as the end of this month, it's which is a couple of days from now, or early into next month, that we'll be getting a resolution in the SEC case. If it turns out that Ripple beats the SEC, which is what the market is pricing in, right? The big Ripple is ripping. That's really interesting, right? I think that's gonna have an impact on the market. And I think, depending on how the Grayscale case goes, and that's gonna play out over time. So I think there's a few kind of crypto specific things, but look, I think broader macro, right? Interest rates being high doesn't spell well for crypto. DeFi is one of the biggest things. DeFi yields are worse than treasury yields, and they don't have the risk that, you have all the DeFi specific risks that you don't have in treasuries, right? So I think there's some adjacencies, but I think there are some things that are unique as well.
And let's end this on a positive note, because there are some positives out there. As you had noted, there's more non-crypto native institutional service providers that are coming into the system, trying to separate where you're not an exchange, you're not a clearinghouse, you're not a custody, you're trying to almost make it mimic a more mature market structure. And I think that could also help with institutional adoption.
I totally agree with you. I mean, I think the greatest example, I'm going to give you guys a little shout out, is Nasdaq launching crypto custody in Q2, right? So we're starting to see that, right? And we've seen that kind of across the board. Cowen, we'll see what happens now that they're acquired by TD, but they're very aggressive, offering full prime services to institutional clients. We've seen BlackRock announce that Bitcoin trading is going to be live in Aladdin, right? We've seen State Street and others talk about crypto custody. So I think there's a lot to be excited about. And I think one of the questions we asked earlier is, what are the barriers for adoption? One of them is the fact that a lot of traditional institutions don't want to do business with somebody whose balance sheet is primarily crypto. As I mentioned earlier, the revenue of these companies look like this, right? And so if you can do business with Nasdaq, Nasdaq's primary business is never going to be crypto custody, right? You have the benefit of the balance sheet of somebody like Nasdaq, or somebody like Boney Mellon, or somebody like State Street. So I think those are all positive things. And we saw this morning even Fidelity announced that they're continuing to expand their team. So I think there is a lot to be excited about from the institutional perspective.
All right, Josh, appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.